Good morning, everybody. Hopefully you had a good weekend. We got a lot of information to cover today, so we'll go ahead and get started here. Oops, went a little too fast there. 5-minute moneymaker. Last week, I just read this article from HubSpot titled 6 Signs You're a True Hustler. So you're concerned with what could go wrong. That's a good thing. You're insanely dedicated. You play the long game. You create your own opportunities. That's getting lucky. And believe in yourself, and you are busy meeting people, busy learning new things, busy honing your skills, busy being a better person. And that's where, during your workday, we need to make sure you're doing something that's productive. So 5Q tape breakdown, how a great Monday morning coaching call can hurt your meeting. Don't point the finger too soon. So please go back and look at this. This is something that a lot of advisors do. In fact, this is very apropos to what we're doing today, and saying that a lot of the information we give you is for you, not for you to give to the clients. What should we be doing with the clients, guys? Should we be ad-libbing with the clients? Can I get some answers to that? No. You have a script, that's what you should stick to. So when I'm showing you all of these things on the Monday morning calls, it's for your edification. It's for you to become smarter and more. It's for you to be more confident in what you're doing. It's not third-party information to give to clients. Because, guys, what's the problem with third-party information to give to clients? Now, we do it a couple of times in the 21-point checklist, but what do we do? Every time we give third-party information, what do we do before we show the third-party information? Yeah, we get, we don't cite credibility. Wade, you may be right saying validate source. Who validate? That's right, Dave says. Make them buy into the third-party research. Right, Wade. They have to buy in to the third-party resource. If you just show out third-party resources, what do they know they can do? If you throw out a third-party resource, yeah, who cares? One thing, but what else can they do? Well, for every article I give you, guess what there exists? A counter article, exactly. So that's what we're talking about in this 5Q tape breakdown. That's kind of what we're going to cover today. The stuff we cover today is not for you to basically just give to the client, say, look at this. But this is the kind of danger that we're in now. This is an article right out of Inside Business. Bitcoin is my potential pension. What's driving people in Kentucky to join the craze of Bitcoin? This is just a clip from the article. Jacob Meehan, this is the caption under the picture of him. Jacob Meehan, right, helps the client Jim Baker analysis of crypto consulting group in Louisville. This Jacob guy, he had invested in Bitcoin almost 2 years earlier. So Jacob Meehan had a new house, a new truck, new consulting business, and a line of people coming to his office trying to become wealthy as quickly as he had. Is this a problem, guys? So is Jacob Meehan brilliant? Is Jacob Meehan brilliant? I would agree that way. No. So, yeah, he's a lucky bastard. That's what he is. I was talking to my son this weekend about the whole Bitcoin thing, and the millennials just roll their eyes at Bitcoin. And, you know, when it comes to this stuff, guess who I trust? Jacob Meehan, who's a 59-year-old guy who thinks he's genius, or millennials when it comes to things like Bitcoin? Who do you think I'm going to trust? And both my sons who are millennials, they roll their eyes at Bitcoin. Now, but I was talking to him, and I said, you know, if you had 5,000 people, you got a six-shooter. You have a six-shooter, and you have 5,000 people who sign up for $1 million prize to win that they'll win if they win this contest. And the contest is a Russian roulette. So the first time they spin the revolver, how many people are going to lose? It's a six-shooter. How many people are going to lose? Or I'm sorry, six-shooter. I'll do 6,000 people instead of 5,000. Make it easier. 1,000 people are going to lose, right? 5,000 will win. Then you do it again, and it keeps paring it down until finally, are we going to be left with maybe 10 people after we've done this 50 times? Are we going to be left with 10 people who are still standing doing Russian roulette that way? Yeah. So can they then classify? Should they be Jacob Meehan here and set up a school because they're geniuses when it comes to Russian roulette? They figured out the game. Should they? No. Why? So out of 6,000 people, they were just the lucky guys that won. But this kind of stuff happens all the time. And is it just limited to things like Bitcoin? No. Guess what? Guess what? Also, people also do to a lesser degree. They do the same thing when it comes to the investments in the stock market. So what is the purpose of an FIA? What is the purpose of an FIA? How about in our portfolios? I'm sorry, that's a bad thing. I asked a very general question. I need to ask specific questions if I want a specific answer. So what is the purpose of the FIA in our portfolio? Okay, so I'm getting a lot of safety, short-term guarantee. So what part of our portfolio should this be? It should be in this. We should have two parts to our portfolio. One is growth, one is safety, and what is the FIA designed for? The safety portion. And that gets some people confused. And Jerry and Matt at ECA constantly counsel, and I know Jeff does too to a certain degree, counsel people where you get kind of confused about, well, geez, you know, obviously participation rates are going up and up and up as interest rates go up. But even back at when interest rates or when participation rates at 42, people would say, but the participation rate is only 42%. Well, guys, first of all, what happened with that 42%? It blew the market away for 16 years. But even is that what it was designed to do? And I get confused. It's not designed to blow the market away. It's designed to blow what away? What is it designed to blow away? Bonds. Bonds. It kills bonds. If it beats the market, what do we know it does to bonds? Kills them. Is it more liquid than bonds? So it kills bonds, rates of return wise. Is it more liquid than bonds? Yes. Is it safer than bonds? Yes. Why? Because you have to wait to maturity for bonds. I mean, do most people buy bonds or bond funds? And what's more safe, bonds or bond funds? Bonds are, but everybody else buys bonds where you can lock in those gains. So it's to give you that 50-50 portfolio balance, or the 60-40 or 40-60 or 70-30 or 30-70 portfolio balance of both growth and safety. But what we're happening now, so we had this big downturn in the last 10 days or so, and we should have known that was coming, right? Because first of all, Kiplinger magazine, stocks are still the place to be in 2017. So as soon as you start seeing magazine covers touting stocks are the place to be, what should you be? Yeah, you should be scared. This is kind of funny. Fear of missing out, FOMO. You know, that's what they say about Facebook that creates FOMO. People are fear of missing out because everybody's on vacation 24/7 on Facebook. But it also happens with the stock market. So this was published January 26, 2018, and guess what this article was about? Want to guess? We're late into the bull market, 8 years of growth. Guess what people were doing? This is inflows into the stocks. So back in 2008, when they should have been putting money in after this big downturn, what should they have been doing? When should they have bought? Back here, 2008. But guess when they started to put money in? 2013, right? And then they started putting money in, so they missed all of this growth right here. Then they said, oh my gosh, I missed all that growth. I need to get back in. And then they started to get wise here, but guess what? And they said, I got to capture some of these gains. And then after a couple of years, the market's still going up. What'd they say? Holy crap, I got to miss again. So what have they been doing the last year? Piling money in. Smart thing or not so smart 8 years into the market? But now that we've had that correction last week, we have nowhere but to go but up, right? Now that we've had our 10% correction, we have nowhere to go but up. Yeah, everybody's getting that answer right. Because what are the talking heads saying here? What are the talking heads saying? And the problem with the talking heads is, Upton Sinclair wrote, it is difficult to get a man to understand something when his salary depends on his not understanding it. Why are the talking heads all about being in the stock market? Because if they said get out of the stock market and move to the bank, guess what? Now, I love this blog, A Wealth of Common Sense. He had an article saying there are plenty of headlines you won't see during the sell-off. One is savers celebrate as stocks go on sale, or dividend yields rise along with expected returns as stocks fall. Young investors rejoice as market crash, providing better entry points at lower prices. Markets fall for reasons that no one can be sure of because investors have much different goals, opinions, strategies, time horizons, and risk profiles. I love, of all these headlines, this is the most accurate. So, what are all the talking heads saying right now? All the financial planners at the local news, all the experts on the national news, what are they all saying? Stay put, hold on, right? And they trot this out. In 2007, the market hit a high of 1539. It hit a low of 757. Well, guess what? The market's now at 2700. So if you would have hung on, guess what? You would have made what? 75% increase even from the high of 2007. Geez, if you would have invested at the low, you would have made 3 times as much. Have you seen these numbers being thrown around 3 times as much on the national news and the local news? Have you seen these numbers being thrown around? I need everybody to answer this. Yes. So it's accurate, but as your mom said, if you're is a half truth okay, or do you got to tell the whole truth? Half truth or whole truth? Because they're playing a shell game here, aren't they? They're all saying keep calm, buy and hold. Look at even after 2007, when the market crashed in 2008, it went down. It went down half. Even if you would have stayed on, you would have tripled your money over the last 8 years. Here, you would have been up 75% if you would have just held on. What are they forgetting to tell us? What shell game are they playing, guys? What shell game are they playing? Please, somebody tell me. Nobody's getting it. The guys who gave me answers, those are good answers, but it's not the shell game they're playing. Guys, where was the S&P 500 in 2000? Then it went up to 1539. Then it fell to 257. Then it made it back to 1485. How many years did it take for those people to get back to 2013? Or to get back to 1485? 13 to 14 years. So are they talking about that? When they say, geez, if you would have held on, you would have tripled your money in the last 8 years. Have you heard anybody on the news? Please tell me. Has anybody heard anybody on the news talking about this? So we got 1 yes and about 40 no's. I haven't heard anybody talking about it. All they're talking about, geez, if you would have held on. So 13 or 14 years to break even. And then if we go back 2,700 to 1485 in 2000, it would have been up 82%. You would have made 82% over 18 years. What's your rate of return there, guys? 4.55. Is anybody talking about that on the news? No, all I'm hearing is, geez, but if you would have held on, for the last 8 years, you would have tripled your money. So are they do you get why what the news is doing there? They're selling what? And you know what? To be straight out, how many advisors are talking about this? Do you think the news is the only people that are doing this? How many advisors are talking about that? Or are they just saying, hold on, because you know what? You would have tripled your money in the last 8 years. Now, some people say, well, Mike, that's not fair because you're not including dividends in that. Well, what am I including in that, guys? Because the dividends are 1.8%. Yeah, I'm not including the fees in that. So it's even Steven. So please don't say I'm not being fair with these numbers because of the dividends, because 1.8% is what the S&P 500 is paying. Believe me, if you want me to go to your clients and show them the fees they're paying, guess what they're going to find out? 1.8 is what? Cheap compared to what a lot of advisors charge. So it's an apples to apples comparison. So, and the other thing that's been I've been reading a lot of, even before this correction over the last 2 weeks, in the last 6 months, so I've been reading a lot about this, is that when guys are asking people what risk you're willing to accept, when they say 25% downturn, that's the average people say they're willing to accept. That's a problem. Why is that a problem, guys? And you wouldn't know this. I mean, you'd have to have been reading the same articles that I was reading to know this. The problem with the 25% downturn is when the same people that say they're okay with a 25% downturn or say, are you willing to lose $125,000? Guess what they say? They suddenly would be screaming at you. Do they get the 25% equals $125,000? Which hurts more, 25% or $125,000? The money, the money, the money. So I wanted Jeff to talk about, obviously we've seen the down 10% correction. So we should be telling our clients, you got money in cash right now. We should be getting in. We can buy cheap. Have you heard that on the news? I freaking heard that on the news. Have you heard of that on the news? So Jeff, what would you say to that?
Well, if you look at this graph, and I realize you're handicapped because you don't know what this is and you don't know the time frame, but just looking at that, would you say that's a good investment to be in? I mean, what would you guys say? Yeah, it's a great. That's
overall,
Bitcoin.
I mean, if you're in the beginning.
Yeah, that's Bitcoin. And we talked about Bitcoin to start the call. I mean, does anyone want to be in Bitcoin right now? And the interesting thing about this graph is that's not Bitcoin from the beginning. That's Bitcoin last week. So should we have been telling our clients, hey, it's over, let's get in Bitcoin? Is that what we should have been telling our clients last week? I mean, we don't know. We just don't know. Here's where you see it a little bit. It's a little bit easier to see. Oh, Mike, you have to advance the slide.
Oh, sorry. Sorry about that.
So let me just ask you guys, because let's just start off easy. Would you say that's a bull or a bear market right there?
Everybody saying bull?
Okay, that's a bull. You're absolutely right. Next, what about that? What would you say?
Bear.
Bear, that's a bear. Next one. What would you say about that? Bull, that's a bull. Next one. Bear. What would you say? That's actually a bull dip. So that's a dip in a bull market. That happened in April of 2015. You look at that and you think, well, that's not very good, but actually that was a great year. 2015 was a really good year in the market. You wouldn't know it by looking at that, but it was a good year. How about the next one? What would you say?
Definitely bull.
Yeah, that's March 2017. How about the next one? What would you say?
A dip.
Oh, no, that's a bull market. That's November 2015. How about the next one? What would you say?
That's a bull?
No, that's actually bear rally. That's November 2001. How about the next one? What would you say?
Bull?
That's a bull. That's September 1997. How about the next one? They look identical. Yeah, they look identical. What's the next one? Last one. What would you say?
Bull.
That's a bear rally. That's September 2008.
Look the same.
Yeah, and that's the point. How can you tell the difference between a bear rally and a bull market? I mean, you really can't. The only way that you could really tell is if you were able to look out over time. And then you could see, oh, that's just a dip in an overall down, or that's a rally in an overall, that's just a dip in an overall up, or that's just a rally in an overall down. It takes time to know. We can't look at these things and just know what's going on. A good example of that is 2008, because we all know that 2008 was the beginning of a market crash, right? But in June of 2008, the Dow was at 12,000. It was at a high, 12,604. But now look at the next one, September 15th, 2008. That's the day Lehman Brothers declared bankruptcy. And the Dow lost 504 points. Then we go to September 19th, 2008. So now the federal government steps in and says, we have a plan to bail out banks. So now what does the market do? It goes up. And do we have to worry about that Lehman Brothers going bankrupt anymore? Because now we have a plan, right, to bail out the banks.
Right. So
now we can get back in, right? Well, look what happens on September 29th, 2008. We lose 7 cents. That's the day the Senate said, you know what, we don't approve the plan. It doesn't pass. One day loses over 700 points. So now we're back into bull or bear territory. And as you can see, the market actually declines steadily over the next 12 days until we're at 8,451. October 13th, 2008, that's 936 gain. So that's when, I don't know, is the next slide, what does the next slide say? Next slide. Is this
Question mark.
Oh, okay. Well, let me read you. This is October 13th. This is CNN Money. This is what they had to say. The headline is Raging Bulls. Dow jumps 936 points and S&P up 104 in the biggest point gains ever. The Dow, S&P, and NASDAQ all gain over 11%. So here's what the bulk of the article says, just reading from a little bit. Stocks rallied Monday afternoon, with the Dow rallying 976 points during the session as investors bet that the worst of the credit crisis is over, following a series of global initiatives announced over the last few days. The Dow Jones Industrial Average ended 936 points higher after having risen as much as 976 points during the session. The advance was the largest ever during a session on a point basis. The point gain was equal to 11.1%, the best one-day percentage gain since September 1932, and the fifth best ever. And so everybody's thinking the bear market or the correction is over.
Nope.
Or was it?
Not even close.
Not even close, guys. And you could look at that 936 points and see all the initiatives and all the plans and all the things they had in place and think, okay, well, now we can get back in. But we all know that from that point forward, it just got worse until it bottomed out in March of 2009, where it hit the low of 6,507. So the question mark is this: do we know what's going to happen? No, we don't. We always tell people, if we had a crystal ball, we certainly wouldn't be sitting here talking to you. We'd be on our yacht in the Bahama. See, what people that you meet with, what they want is certainty. They want to know what's going to happen going forward. But can we give them certainty? Do we know what's going to happen going forward? No. Does anybody know for sure with certainty what's going to happen going forward? No. So while that may be what they want, what they really need is a plan. And that's something that we can give them. We can give them a plan that works regardless of what the markets are doing. We can give them a plan that works in the best of times and the worst of times. We even tell them, do you want us to plan for the good, the bad, or both? And what does everybody say? Both. Yeah. So we can give them a plan where they know that they have all the information they need to make good decisions. We can give them a plan where they know that nothing is withheld from them. We can give them a plan that they know that when the market's up, they're going to make money. And when the market's down...
So you're not saying that our plan is to have to take all their money out of the market because we don't believe in stocks?
No, absolutely not. That's not our plan. Our plan is to put them in a 50-50 portfolio so that they know that when the market's up, they're making money. When the market's down, what do we tell people? You'll lose money. But markets are generally up more than they're down, so the long-term plan is to make money, and we don't have to worry about it because we have money in something that cannot go down. We've got a hedge.
Can I jump in there, Jeff?
Sure, absolutely.
Because one of the things I've always said is those managers who say they've got it figured out that when the market goes down, they won't lose money. I'm gonna say that, you know what? I'm one of those guys who says that. Only I can guarantee that. How can I guarantee that when the market goes down, you won't lose as much money to my clients? How can I guarantee that? Yeah, because 50% of it is in guaranteed. So that means at least 50, and probably more like 60 or 70% is in guaranteed. So when the market goes down, at least 50 to 70% of the money is not going down, which means they'll lose what as compared to the market? Less. And when the market goes up, I can guarantee them that though they won't make all the return, but all of their money will be making money. Now, a money manager is doing that with stocks and bonds and algorithms. Can they make that guarantee? Because would I be willing to put my house up for as collateral to a client that says, okay, I'll give you $30 million if you can guarantee that? Would I be willing to put my house up saying, yes, I will put my house up. I will put my house up and mortgage. I'll give you my house if it does not work that right. Would I be willing to do that with? I would. Why? Why would I do that? Guys, why would I do that? Fred's got it right. A lot of people else got it wrong. Why would I be willing to do that because if my client is in 50 to 7% FIAs, am I worried about losing my house if the market goes down, that they're going to make less, or the market's going to go down less than, or I'm sorry, they're going to go down less than the market? No, I'm not worried about that at all. I'd make that bet all day long because I know 50 to 70% of the money is not going down, which means that they're going to go down, their portfolio is going to go down way less than the market. Also, they're going to be brave enough to keep the stuff that's in the market where it's at. So when the market comes back up, they're going to make more money. Sorry, Jeff.
No, and that's exactly the point. We can't be trying to time the market and look at 1 day or 1 week or even 1 month point gains and say, oh, we know what to do. We were guessing when we looked at those graphs. We had no idea. And if that's what we're basing our decisions on when we meet with our clients, we're guessing. And we don't want to be guessing. We want to have a plan in place that works regardless.
So guys, I would make that bet. I'd put my house up on mortgage. I would mortgage it, give you my house, my fortune, my firstborn if it didn't work out that way. How many money managers that make that kind of promise will do that? That say, hey, you know what, the way my algorithm works is that you'll get less, you might not make as much money, but on the downside, you'll not lose as much money. Do they say that, guys? Do they say that? Yeah, sure they do. That's their whole pitch. But how many of them put anything, make any sort of guarantee on that? None of them. So this is another thing, is like everybody got together and said, what we need to say is the stock market is not the economy. How many times did you hear that freaking phrase over the last week? The stock market is not the economy. How many times did you hear that phrase? I heard that on MSNBC, CNBC, on CNN, on Fox, on Good Morning America. I heard it over and over and over. It's like they all got together. Well, guys, let's talk about it. I agree with that. The stock market is not the economy. So can we talk about the economy? Because what I tell people is you need to be in stocks. You need exposure to stocks because if you don't believe that the economies over time will grow, you should be buying beans and ammunition. So we got two choices. Believe that over time the economies will grow, the American and global economies will grow, or we should be buying beans and ammunition. We just don't, as they point out here, the stock market is not the economy. But over time, is the stock market the economy? I mean, this is what Warren Buffett talks about. Over time, the stock market is the economy, because if the economy keeps growing, the stock market will catch up. But the problem with the stock market is it locked at the hip with the economy? Or can the economy going up and the stock market fall, and the economy going down and the stock market go up? Can that happen? In fact, it does. It does that more often than not. So consumer trends show softness. So what percentage of our economy is consumer spending? The answer is right on the screen for you. 70%, right, Raymond? 70%. What's happening to consumer spending? It's falling. Why? And see, here's what we have to understand. GDP growth equals productivity growth plus population growth. What's been happening to GDP growth since 1962? Now, during the booming 90s, it stayed even. It was flat. And that's where we made a ton of money. But what's been happening since? Can the stock market continue to grow if GDP does not grow, guys? Temporarily, yes, but long term, can we be getting a 10% rate of return on the stock market if GDP is at 1%? No, you can temporarily, but over time, guess what? If the economy is not growing, what's going to happen to the stock market? Yeah, big picture is it's based on the GDP. So what's happening to productivity growth? Well, and what's happening to population growth? So let's talk about productivity growth. Or let's talk about population growth. What's happening to our population in the U.S., guys? It's shrinking. And with all the talk that's happening with immigration now, what does our government want to do? Make it go what? Go bigger or smaller? Let more people in or less people in? So people aren't having as many babies, and we're going to let less immigrants in. Guess what's going to happen? There's only one direction that means that the population is going. And why is population so important? Because, guys, what percentage of our economy is based on? What percentage of our economy is based on consumer spending? So if we have less people, that means there's less people buying. Now, of course, if they're making lots more money, that's great. But where is all the wages increase? Where is all of the income and wage increase gone over the last 15, 20 years? To the top 1% or to the bottom 99%? Which is great, but I'm one of the top 1%. But I drive a Subaru and a Kia. So how much money is that of that am I spending? I live in a normal house. How much? And I have a lot of friends with that kind of income. They're in that top 1%. Guess what they're spending? So if we're not seeing wage increase with the other 99%, guess what that means? People are not going to be buying, or more going to be as much, or going to be buying more. Now productivity has gone up. Why has productivity gone up? Two reasons. Why has productivity gone up? Automation. Well, robots, and I'm going to say automation are two things. Robots is one, and the other is what do you call it when they don't stock things? It's they only basically they've got it almost down to a perfection that they only make just in time shipping. Yep, they only make things just in time to ship it, so they don't end up with a gazillion things that they don't need. So that's where all the productivities come from. And what's happened to compensation? So even though productivity is better, who's going to be buying this stuff that we're making, guys? We don't have more people, so there's no more people to buy, and then the Russians. So it says, Kevin says the Russians. So do you get why? The fact is that GDP, are we ever going to see GDP at 3% for long periods of time going forward with what's happening right now? No, which means what? GDP is economy is based on productivity and population. Less people, more, and are these people in more debt or less debt than they were back in 2007, before the 2008 crisis? Are people in less debt or more debt than they were then? Do you realize that we are now back to where we were before in 2007? That people have more personal debt than they had in 2007 before the markets went gonzo. Flat wages, robots replacing good jobs. And Shiller, you've heard me talk about the Shiller PE, the CAPE, the Shiller PE ratio, and this is as of Friday. It was 31.29, so it's way up here. So that is in danger territory or not in danger territory? Again, price earnings ratio, the profits that people have, what people are willing to pay for stocks based on the profits they have. And that's very, very dangerous. In fact, there's only been two times that it was more dangerous is what? 2000 and 2008. Other than that, it's never been more dangerous. And that's after the correction. So do we have any more room for correction, guys? Do we have any more room for correction? Lots of room for correction. We're still at that's only been higher twice in 2000 and 2008. So we got plenty of room for correction in the Shiller PE ratio. And again, what happens to earnings when there's nobody buying your crap? Yeah. So what's that going to do to the PE? This is another thing. This is where, have you seen some of these people that were shorting the VIX? What happened to them in the last year, or last week? Yeah, lost 95% of their money. So this is the VIX versus the bull market. So volatility has gone down, the market's gone up. Have you ever heard of a reversion to mean? What's going to happen to these two graphs? They were way up here and down there. Now they're way up here and down there. What's going to happen? They're going to converge again, which means volatility is going to go up, and the bull market or the S&P is going to go down. It's just is that maybe, or is that just the way it works? It's just normal. That's the way it works, exactly. See, reversion to mean. Sometimes we're way up, but anytime we're way up, what follows that? 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 So it's reversion to mean. So guess what's going to happen to this graph sooner or later? And do you think it's sooner or later? And as Jeff just said, one of the things we ask our clients is, if I had a crystal ball and could tell you when the market was going to go down or when the market was going to go up, how rich would I be? And would I ever tell you that, guys? I'd be filthy rich, right, Fred? And would I ever tell anybody that? Would I ever give anybody the insight on that? Yeah, maybe family, but that's about it. I certainly wouldn't be telling clients that. Why? I wouldn't need clients. How rich would I be? And the more people I tell, guess what? The more people I tell how the market's going to work, the more likely what? Yeah, it dilutes it. You know, again, I was talking to my son this weekend. Who made the most money during the gold rush in San Francisco? Who made the most money during the gold rush in San Francisco? Not the first people. You got it, Till. Till's got it. Yep, Bill's got it. The guy selling. Guess when Levi Strauss became a multimillionaire? During the gold rush. Yes, you know, I forget who. Does anybody remember who says, I don't dig gold, I sell the gold diggers shovels? I forget who said that. I sell the gold diggers the shovels. That's how you get rich. And I was telling my son, you know, he's talking about the Forex markets. He was in college. He was talking about the Forex markets. And I said, dude, the only people that make it rich in the Forex markets are the people who are selling their systems on how to get rich in the Forex markets. Guys, if you had figured out how to get rich in the stock market or the Forex market, would you be selling your system? No, because what would that do to your system? If everybody knows the shortcut, if there's an accident on the highway and everybody knows the shortcut, what's going to happen to that shortcut? It becomes a long cut. So the only people that make money, you know, why do money managers say they've got it figured out? If the money manager really had it figured out, guess what? You wouldn't be telling people. Now, the only reason I say I've got it figured out is why? Because on the guaranteed side, I do have it figured out. You're not going to lose money on the guaranteed side. And what's my guarantee on the growth side? When the market goes up, you're going to make money. When the market goes down, you're going to lose money. And historically, more often than not, the market goes up. So am I okay with those two guarantees? When the market goes down, you're not going to lose money. I'm okay with that guarantee? And am I okay with the guarantee that when the market goes on the growth side, am I okay with telling a client when the market goes up, you're going to make money? When the market goes down, you're going to lose money. And more often than not, it goes up. So am I absolutely okay with my guarantees on both sides? Would I mortgage my house on that? Would I give them the mortgage? Absolutely, I would. So here's the thing. How safe is this room? When it comes to fire, how safe is this room? So what I tell people is this, is we have a room full of 50-year-old newspapers, dry as tinder. You know, we've got oil-soaked rags. We've got super dry wood, and it's in this, and we have a gas can here. Is this room on fire? Is this room on fire? No. But it's only a matter of time. I mean, how much of a mistake would it take for this room to go up? How much mistake would it take for this room to go up? Now, does that mean that it's going to go up? And could it be like this for 10 years? Yeah, could. But one tiny little glitch could cause this thing to go up in flames. Now, if I had a concrete room with just a small pile of newspapers, how much risk is in there in that? If I had a concrete room with a small pile of newspapers in the middle of the room, there's no risk to that. But right now, it's more similar to a concrete bunker with a small pile of newspapers in the middle, or is it more looking like this, where we've got solvents and gas and a propane tank, and we've got dried wood and oil-soaked rags? Which one is it closer to? That's a hot mess, exactly. So how much of this have we taken out over the last week? How much of this we've taken out? Well, maybe we removed the propane tank. That's about it. But the rest is just still sitting there. Now, does that mean we know when it's going to go out? No, we have no clue. This room could go for 10 more years and never a bad thing happen to it. It's just saying that how much of a mistake, how much of a hiccup would it take for this thing to go up? Not much. See, that's where we're in right now. So what kind of black swans are swimming around out there? Guys, this is the red is the danger zones that can cause problems in the world. So how many of those exist? Lots. We got hacking. What could hackers collapse this? Could hackers collapse this market? How hard would it be for them to collapse the market? Do we even know what they would hack into that could cause a collapse of the market? They could hack into they could hack into the banking structure. They could hack into the government. They could hack into a NATO. They could hack into the New York Stock Exchange, or as Dale just said, they could hack into the grid. Guess how problematic our power grid is. You got it, Michael. It's very, very, guys. Just I don't mean to panic you, but our electrical grid wouldn't take much. And what could bring down the electrical grid? And would that cause a market crash if a big chunk of the country went down because the power grid went down? Yeah. So what could cause it? A hack could cause it. Did you know that almost this part of the country, the western third of the country, almost went down in the 1990s? I'm sorry, in 2004, 1990s, 2004, because a guy shot out a transformer on a pole that caused a surge that knocked out one power station after another all the way up the coast. It was in Nevada. Oh, sunspots could cause this. An EMP could cause this. I mean, we go on and on and on about this. How about a gridlock in the government? Could that cause the market to crash? How about irrational exuberance? Could that cause the market to crash? In fact, how many different things? How about household debt? Could that cause the market to crash? This is remember we talked about household debt. This is how much people have borrowed. This is 2008, and this is current on how much money people have spent or have right now borrowed to buy cars. Is this a problem, guys? Yes, this is a problem. And remember this? Oops. So how do I do that again, Tricia? Let me see here.
Just click on the actual image.
On the image? Oh,
yep.
You guys are so smart. Thank you. Do you guys all remember this? Where we talk about, here's the world's silver, cryptocurrency. Here's the 50 richest people, California's GDP. Here's the stock markets, all the stock markets around the world. Here's the global money supply. Here's global debt, global real estate, and then we have derivatives, and derivatives, and derivatives, and derivatives, and derivatives, and derivatives, and derivatives. So how much risk is there in the market right now, just when it comes to debt? And Fed tightening. Guys, how much of a razor wire is the Fed walking right now? And we've got one person making the decision. That's crazy. And how much ammunition does the Fed have? If the market goes down, how much ammunition does the Fed have to get the market kicked back up again? None. Interest rates are too low. What, are they going to lower interest rates by 0.5% to get the market going again, or the economy going again? Yeah, we're painted into a corner. So life's not linear at all. It happens in lightning flashes, so fast you don't even see those layout cold moments coming at you until you're Wile E. Coyote steamrolled flat as a pancake by the Roadrunner. Victim of your own elaborate schemes. Guess what this applies to, guys? All the algorithms out there, all the talking heads out there, anybody who thinks that they've got it figured out, guess what's going to happen to them? They're Wile E. Coyote. They have no clue. Because black swans, give me the number of how many black swans there are. How many black swans are there out there? I agree with that, Wade. How many things can cause the market to go? It's unlimited, right? It's unlimited, Michael. So this is a graph I showed you a while back. It's from Wall Street Journal, Robert Schiller. The first time the market hit 100 was 1906. Guess how many years it took to get back to 100 again after it went down? 1933. How many years is that? First time the market hit 200, it went down again. Guess how many it was in? It took 15 years to get back to around even. First time it hit 1,000 was 1966. When did it hit 1,000 again? After, and then it went down during the 70s. And how long did it take to get back to 1,000 again? First time it hit 10,000 was 1999. How long did it take to get to 10,000 again? A decade. So we've hit 20,000, we've hit 25,000. What is this graph telling us? That there's no way it's ever going to go below 25,000, no way it's ever going to go below 20,000. What is this graph telling us? It will go down, a reversion to mean. It will go down, and then how many years will it take to get back to ground even again? Couple years? Or a long time? Now, the great thing about FIAs, when the market goes down, are you punished or are you rewarded for that? I mean, the reason that the FIAs at a 42% participation rate cream the market from 1998 for 16 years, from 2000 for 16 years, which is all we've got the data for, the reason it creamed it is why? Because it's only getting you 42% of the market. Is because what? When the market goes down, you're constantly buying low, selling high, buying low, selling high. You don't have to get the market when you don't lose money. Warren Buffett's 2 rules: never lose money, and number 2, don't forget number 1, never lose money. So guess why I piled my own personal money into FIAs? And guys, I'll go one-on-one with anybody who wants to go on investment theory with me. I'll go one-on-one. But all the investment theory in the world matters or doesn't matter? Doesn't matter, because in the end, guess what? The market going to do what the market going to do. And since I know I can't, you know what knowing all that market theory has convinced me of? That it's worthless. You can't predict what the market's going to do. Because if you could, how rich would we all be? So that's why I pile all my own personal money into FIAs. And again, look at how, again, this is just another graph, again, of all the different bear markets we've had. How much from return to, it had to go up 11% here, 15% here from peak to trough, or I'm sorry, this is what it went down from peak to trough, went down 11%, 15%, 37%, 87%, 54, 26, 20, 28, 22, 36, 48, 27, 33, 49, 56. Do you think right now, and this is 2015, then we went up more. So do you think really, as high as the market is right now, are we going to be closer to the 11% correction or closer to one of these bigger numbers with reversion to mean? And again, where are we right now for PE? We're at the 86. We're at 31.29. So we're at 31.29. So guess what it's looking like, dudes? So fear is hard to fight. The chance, I love this graph, the chance of you'll bail out on your strategy. When you lose 50%, and when the more you lose, which is, again, people are not smart when it comes to money. The more you lose, the more you should stay in. But is that the way it works? The more you lose, the more you're locked. You have to be locked in. But instead, the more you lose, the more likely you are to bail. And again, sentiment is behind reality. Everybody's the peak of the market's here, and optimism, right? It's starting, and that's what we're seeing, right? That's when people start to pile in their money right here at the peak, and they're hitting a euphoria. And then what? Do you get this? The market, whatever happens to the market, people's attitudes are lagging what's happening with the market. It always lags what's happening in the market. Right now, you saw what was happening with the amount of money that went in January. Where are we? Are we way down here at despondency, or are we here at euphoria? So what does that mean that's going to happen in the market? Well, we've seen a 10% correction here, but we've got how much do we have to work out all that euphoria? Is the euphoria gone yet, guys? No, you still got everybody on the TV saying what? This was just a little blip. Get your money in there, man. Get your money in there. We really, really hate to lose money. Again, rates of return and money are 2 different things. Everybody says they'll take a 25% cut. But when you put it into real dollars, they don't want any part of that. So you have 2 kinds of, this applies to our clients. When you're young, you don't need a lot of money because you know you got years and years and years to work. When you're retired, guess what? Now you're counting on that money because you don't have years to work. You need to be what after retirement? Unless you want to go back working for, as a greeter at Walmart, what do you have to be with your money? Shooting for the stars or protecting that thing with a baseball bat? And the clients that we work with, where are they? Are they here at age 20, or are they right here where they need to be a lot more careful with their money because they don't have the same kind of earning power that they used to have? So what caused these crashes? What caused the 1929 stock market crash? What exactly caused it? Does anybody know exactly what caused the 1929 stock market crash? It's September 20th. The London Exchange crashed when Clarence Hatry jailed for fraud. Did that have anything to do with the U.S. stock market? No, it doesn't, but it ended up what? Yes, it did. And are we nearly as connected? In 1929, was the world nearly as connected as we are today? By a little or a lot more connected today? So that means how many different things could happen in the world that could cause a stock market crash? Well, it depends on millions of things, right? Because it depends on how many countries they are, and then there's millions of things inside of each one of those countries that could cause it. So what happened? What caused the 1973-74 stock market crash? The collapse of the Bretton Woods system. And we all know what the Bretton Woods system is, right? Yeah, well, go look that up, because that's what caused the 73-4 stock market crash. What caused the 1987 stock market crash? Iran firing missiles at 2 U.S. flagships. Of course, that could never happen again, right? No, it wasn't program trading. These two things happening caused what? The oil crisis. And then the oil crisis caused what? Doubt in the market. And then the doubt in the market caused what? Program trading. But program trading causing the market, then why didn't it happen the week before? The program trading, that's what everybody says. And everybody says, so Fred, it's not that you're wrong. I hear that probably 90% of the time when I ask an advisor what caused the 1980s stock market crash, they all say program trading. That's what I thought too, Fred. So, but in reality, program trading could have happened when? So what caused the program trading then? It was that Iran fired 2 missiles on U.S. flagships in 1 week. Could that happen again, guys? Are we anywhere? Is there any situations around the world that would be similar to right now? 2000, what caused that stock market crash? You all should know this one. I've talked about it a gazillion times. Very good, Wade. Fred's got it. Wade's got it. AOL buys out Time Warner. AOL buys out Time Warner because AOL had made no profits. They were in debt up to their neck, and they bought Time Warner that had billions of profits every single year for the last 50 years. So they're like, what in the world? How could it possibly, a company with never seen a single profit in its entirety, buy something that has billions of dollars of profit? That is what? Normal or wacko? Wacko. The problem with that is what? Was AOL the first company that had no profits that bought a big company? No. It's been happening for 2-3 years. And again, I just looking back through some of the answers. Guess what a lot of people said for 2000? It was the bubble. Guys, how long had the bubble been going on? How long had the technology bubble been going on by the time it got to 2000? For 3 frigging years. So was it the bubble? No. What exactly caused? Because right now, could we say right now that we're in a bubble? Could we say right now that we're in a bubble? Yes, we could. So what's going to be the trigger? Do we have any clue what's going to be the trigger? And Jeff went through what caused it in 2008? There was, we had the initial, Jeff went through it where we had the initial downturn with Lehman. Then it came back up, and then the Senate said, "Oh, we're not going to cover that." Then it went up, and then we said, but that was the bankruptcy of Lehman what started it. But then the next week, what? We thought they were going to be okay. So how similar are any of these things? And did anybody know these things were going to happen before they happened? In fact, they didn't even know that these were the causes. When did they figure out these were the causes of the crashes, guys? Later, exactly, much later. Because the only way you can figure out when the market is crashing is when? After it's crashed. And not the week after it's crashed, years after it's crashed, because you don't know what's going to happen and how far the market's going to go down. So we had 9 years of return, 18 years of negative return. We had 5 years of return, 25 years of no return. 11 years of up return, 17 years of no return. 17 years of up returns, 11 years of no return. Now we're at, actually, this was in 2014, so we had another 7. So 7 years of up returns. So guys, when you look at this, where do your clients want to be? They want to be in the gray. How much of gray is there compared to purple? Is it a coin toss? If you show this to your client, are they going to think that I should have all my money in stocks? Since it's 50-50, guess what I think I should have in stocks? 50% or less, and then I'll put the other 50% into FIAs. And we all know the answer to this. Over the last 51 years, what percentage of the time has stocks beat inflation? I hope you all know this. You got it, Wade, 1/3 of the time. No, Frank, 1/3 of the time. Frank's new, so he's never seen this before. Guys, help Frank out. What percentage of the time has the market beat inflation for the last 51 years? Yeah, 1/3 of the time. So Missy, can you help me get Frank the coaching call where he'll learn about that, so he's not as dumb as every other advisor out there that doesn't work with 5Q? Because
Yep.
Frank, that's what we all thought. That's what we all thought. It's only 1/3 of the time. And what are people concerned with that were retired? Would like to have enough money for financial peace of mind. Does that mean they're worried about outliving their money? Only 1/3 of people are worried about outliving their money. The poor people. What is everybody else worried about? They just don't want what? They don't want to lose their financial lifestyle. So how much do we need to make then? We need to maintain their lifestyle. We need to stay ahead of inflation. We need to make more than 3 or 4%. So what is the purpose of FIA? Is to balance the portfolio. 50-50, guys, or 60-40, 70-30. And when you do the FI presentation right, how hard is it to get 50-50 or higher? The problem is getting people to want to put any money into the market. So, guys, when you've mastered the crib notes and motive, your daily practice of the MIFT and GOTS, and what's a good excuse for not doing MIFs? There is no good excuse for not doing MIFT. A 5-minute moneymaker, be paying attention to those every week. You're going to get every client you want. So if you're not closing every client, this is a great question to end the call with. If you're not closing every client, what do you need to do? And it's not learn the scripts. That's true. It's not do the MIF. That's true. That's right, Nicholas. Call me, call Jeff. That's what you need to do, because we need to figure out how to get you to that point where you're closing everybody, because you will close everybody when you're doing these things. Make sense? So I appreciate you putting up with this call. I know these are things you already know, but these are things that it's very hard not to hear the siren song of the talking heads and the BS they throw out. So occasionally I want to just bring us back to the reversion to mean, so that we understand, yes, the market goes up, and yes, the market goes down, and anybody who says they can predict it is full of baloney. So thanks for all your hard work, guys, and we'll talk to you all next week. Thanks, everybody.